From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, March 27th, 2026. Let's see what's happening. The first sign of spring isn't a robin. It's the opening of the Night Owl Drive-In near the airport. And also opened for the season, the Brewers, who beat up the White Sox 14-2 on opening day. The Sox are still in town for the weekend. Let's start with some irony. On his way to a crash site, an investigator from the National Transportation Safety Board got stuck in TSA lines for hours. Oh, no. That's kind of poetic. In New York State, charges have been filed against a truck driver for striking 12 overpasses along a New York State highway. The police described him as reckless and ignorant. I'm sure they had a few more choice words when the press wasn't around. And finally, from Independence, Missouri, police say Barbie dolls, possibly contaminated with fentanyl, were found in a discount store Cargo Largo. So that's how Barbie stays so thin. On the podcast today, we have Art Rothschild, Adam Baley, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, Max, thanks for giving us something to laugh about, and grateful that the Brewers gave us something to be happy for, because it was a tough week overall for the markets. NASDAQ down 3.2%, losing 699 points this week. The S&P down 2.1%, and the Dow Jones Industrial Average down 0.9 after losing 793 points on the day of Friday. For the year, NASDAQ down 9.8%, the S&P down 6.7%, and the Dow Jones Industrial Average down 5.7%. Art, hard not to start with a conversation around a market that appears to finally be willing to recognize the real danger that's coming from this war with Iran. I think we spent the better part of the first couple of weeks with the market largely believing it would be over quickly, investors more or less discounting any long-term consequences of that meaningful spike in oil prices. And I think investors are coming around to the idea that the longer this carries on, the further we get potentially from meaningful resolution, the further we get potentially from an easy way out, the more painful it could be for investors long-term. How do you kind of reconcile, and what do you tell investors as we look at a market that continues to struggle with these rising oil prices and this war?
Yeah, long-term consequences of higher oil prices and higher interest rates could be very devastating for the economy. We're starting to see some analysts talk about potential recession. So if this doesn't get solved soon, we could have some problems. And it's good to see the market actually accepting reality. Wars can have consequences that you don't predict. And furthermore, the president himself admitted that he thought things would have been worse on Wall Street. And so the fact that we find ourselves in correction territory somewhere along the way, I think with at least the NASDAQ and perhaps the Dow, it's not year to date from the highs of earlier this year, it's important for investors to do a reality, do a gut check. The long-term effects, again, as you suggested, if it doesn't get solved, you're talking higher prices, so this exacerbates the inflation concerns, less likelihood, which the markets are already recognizing, of lower interest rates to stimulate the economy, and again, a potential recession. Short-term, what this president has kind of proven is that he's somewhat resilient when it comes to his actions and his words. So the market, as we discussed before, some people believe, the market is thinking that this could still be resolved in the not-too-distant future. Just because we lost money this week, it's possible we could make money next week. But that's not the way we invest. We make long-term investments. If you're in the stock market, you have to roll with the punches. And the disappointment this year, I think, more has been the fact that interest rates have gone up. So bonds, very similar to 2022. That's a scary thing for me because that was a disaster year for bonds. I don't think it's going to be that. But whereas a month ago I could look at, do reviews for accounts and see that people were still making money, the day after we did, our podcast a month ago, the war started. And all bets are off now. So We don't know what's going to happen, but we know how to develop portfolios, to maintain portfolios that will enable people to profit long haul, regardless of what might have happened in any given week.
I think that's fair. I would point out that all the good things that were happening in our economy with businesses in the lead up to the start of this war, none of them have disappeared. They're all still out there. There's still these immense opportunities as we look past this current uncertainty, and a reminder that this is something that could be resolved virtually overnight. It may not be the complete ending to this conflict, but it might be enough that investors get some peace of mind that, okay, here's what an exit looks like. Here's what benchmarks need to be hit. And that could be enough for stocks to turn back the other direction. It could be enough to give investors some hope that we can get beyond the current uncertainty and back to those longer-term opportunities. And Adam, perhaps I would add that we're doing it at a time in which stocks now look more affordable than they did even a few short weeks ago.
Yeah, PEs are technically more affordable today than they were a few weeks ago, not necessarily because earnings have come up, but because prices have come down, and that's how the math works out. So yeah, we are no longer above 20, 21 times future earnings, which really was nosebleed territory. I mean, we haven't seen those earnings multiples on the market since dot-com bubble territory. But we're now below 20 on the forward PE. Historically, that's still a bit expensive. But then again, earnings are substantially higher today than they were, back in the dot-com bubble era. So we're seeing some earnings roll in. And you look at earnings for the rest of this year, still looking pretty rosy. Somewhere between, I'd say, 14 and 16% earnings growth is the current estimate for all of 2026. I think investors need to be prepared with all that's going on with a global trade war on top of an actual war in the Middle East. Those earnings projections are likely to be walked back, but even if we walk it back from 16 to 7, that's still okay.
That's still growth, right? That it's still a positive number, and that's what we hope for. I think you are right to point out that a little bit more rosy valuation outlook is based largely on the hope that earnings grow at a pretty significant clip. I think that counts on all that optimism that was out there, and it probably still discounts a lot of the pessimism. We're going to see, though, over the next couple of weeks, the earnings season really kick off in earnest. You're going to see the airlines start to really talk about here's the impact of those higher fuel prices, not just on their costs, but also on, for example, a consumer's willingness to purchase that ticket now at that higher price. United came out and had a day where they talked about already passing along 2 $10 ticket increases and probably another 20% looking ahead. Those are big jumps, and at some point in time, I think consumers look at that and go, yeah, okay, maybe I'm going to rethink that trip to Vegas or rethink that trip down to the Gulf. And so I think that is a thing that could certainly weigh on expectations.
And that's not the only place where consumers are seeing what's called a surcharge on higher energy prices. United States Postal Service this week announced that they are going to be charging a surtax essentially on packages and parcels that got to go a long distance. So we're going to have to pay more to send our packages. You had a couple cruise lines announce that, hey, it costs a whole lot more for diesel. We're going to have to charge you a bunch more for your tickets, just so you know. So we're starting to see some of the very recent price increases due to oil spiking here being passed on directly to consumers.
And Adam, that all feeds into consumer sentiment, and we had numbers today from the University of Michigan that showed that consumer sentiment is already down because of the war, that people are basically thinking that their lives aren't going to be as good 6 months from now, so they're less apt to buy things, and consumer spending counts for 2/3, 70% of our U.S. economy. There are also expectations that inflation will be higher, which will also dampen any sort of trends toward buying, and that could impinge on the economy.
Yeah, it's certainly underpinning a lot of skittishness from consumers. You see consumers being very price conscious, especially as we've seen the tariffs get passed on to us in some form or fashion. And consumers have been more price conscious. And with all of that pessimism out there that consumers have, that we've seen with consumer confidence, you just wonder how bad does it have to get for the confidence before it starts to impact consumer spending. We haven't seen that yet. Candidly, consumers are still out there in spending, but it is something we're watching pretty closely if it's going to impact the economy.
Companies are anticipating that, too. I saw that Olive Garden is actually trimming back its menus and having less expensive fare on their menus.
As long as they don't take fettuccine Alfredo off, we're fine.
Don't forget the breadsticks, Adam. Yeah, I think it is interesting, and it feels very much like an inflection point right now that the longer this war drags on, the more uncertainty there is over the future, the more we're going to see those announcements of how are businesses pulling back on maybe some spending plans, how are they reining in some of that potential future concern so that they can get ahead of the problems that might emerge. And I think that, to me, is really going to be the deciding point over the next 5 to 10 days even, is how well can we establish the exit strategy? How well can we make some steps towards that? Because if it's going to leave a lot of uncertainty out there for businesses that are very much thinking right now about what am I going to spend for the rest of the year and where am I going to spend it, I think that really does speak a lot towards the direction our economy heads going forward. And of course, Art, I think some of the bigger pain points have come from some of the stocks that had done the best. And we got some news this week in especially the tech or the media space that at least put a little bit of a bigger damper still on some of those businesses.
Yeah, Meta and Google were held liable, I think, in a couple cases for really sucking kids into, regular use, getting kids addicted, and the internet becomes a drug for these kids, and with unpredictable consequences. Some kids have killed themselves. Others are just addicted, changed their lives. And this is probably the beginning of more cases to come. So these stocks were obviously negatively impacted by these decisions. It reminds me so much of the days in which tobacco, was found to be responsible for lung cancer, and they had to start putting warning labels, on cigarette packs, and they had huge damage awards that they had to issue bonds to pay these awards. I'm not saying it's that big yet, but I would suggest that the potential is huge for a significant dampening of profits of these companies as they can no longer pander, to kids.
I've been following a bunch of stock analysts that follow these businesses, and just to get a sense on, people who are really involved in the social media stocks and their businesses and their business models. What are their 2 cents on this one? And kind of across the board, they've compared this to a big tobacco-like moment, where decades ago, big tobacco was found that their products were highly addictive and did real harm to people, and you parallel that to the exact cases that have gone through, and it's kind of the same thing. They're highly addictive and they can inflict real harm. So this could have some impact on corporate earnings for some of those social media businesses. There's going to be more to come, but it's something that we're paying attention to.
I think the challenge, of course, is the timing of this, right? That it comes at a point in time in which those businesses were already under pressure because of the high valuations. They were already under pressure because the market as a whole had started to turn. And so we've seen a lot of these really big momentum stocks or momentum asset classes, Bitcoin and gold and some of the things where people piled in because other people had piled in, that are now starting to turn. I think that's probably a pretty healthy sign. The things that have done the best should be the things that sell off the most when there's some fear, when there's some concern. It also, for some things, I think paints a picture of there's some reasons why we should be skeptical, while for others it presents an opportunity. And I think that's one of the questions I have started to get. Dave Sandstrom, one of our colleagues, walked into my office at about 2:15 and said it had been a pretty bad stretch up to that point today, and obviously the last few weeks leading up to it. Is this finally the buying opportunity? I think maybe the short answer is it might be too soon. The longer answer is that if you are an investor in stocks, you're not an investor for the next 3 months, 6 months, 12 months. You're an investor for the long run, right? Stocks for the long run, the famous Jeremy Siegel book, and such an important, I think, tenet of why we do what we do. But Art, clearly investors are going to ask the question, what should I do? Well, potentially they've already done what they were supposed to, but how do you help navigate that conversation?
First of all, it's important that any of our clients or anyone else who's listening who has concerns, that's what we're here for. Call, we'll put it in perspective. Stocks go up and down on a regular basis. The fact that we may be in correction territory is not abnormal. The fact that these stocks have gotten cheaper because of the potential liabilities that they might have argues for diversification. It argues for professional management. That's what we do. We don't put all our money into tech stocks. We have some representation in tech stocks. The fact they've gotten cheaper is offset by the fact that some other stocks have held up quite well this year. Value stocks started the year on a tear. I expect that to come back. Foreign stocks last year, as we've talked about, did better than they've done in 16 years. Started this year off great. I expect that to continue. And we have to have reasonable expectations. We don't know when this is going to be, the current situation, war, whatever it is going to be resolved, but it will be, but then there'll be another one down the road. What happens when we go after Cuba? That'll probably be beneficial for the Cubans, but it'll hopefully be done in a less expensive way. And then there's the long-term consequences of the expenditures that are being made, right now to fund the current conflict and any other future conflicts. And who's going to pay for that? Taxes right now are high enough, but arguably have to go higher. We were anticipating interest rate cuts. Now it's interest rate increases to slow inflation. And as we've talked about, we could have a slowing economy. So it's a time for all investors to be cognizant of what they have. Not to mention, don't go picking individual stocks. These stocks that go down can come back quickly. But why subject yourself to the pain of loss if you can avoid it by spreading your money around?
And Art, for investors who are still acquiring at this time, it's also an argument for dollar cost averaging, right?
Absolutely.
It's a way to get in the market and to to time the market just by always contributing to your portfolio.
You mentioned it's time for investors to be cognizant. I'll just kind of add to that. It's also a great time for investors just to be balanced and stay balanced, because we can never predict the unpredictable, but you can plan for it and you can invest in a balanced way for it. So no matter what happens, somewhere in your portfolio, stocks, bonds, cash, domestic, international, you name it, there's something that's holding its ground. There's something that's paying a dividend. There's something that's paying interest to help smooth out the storm. I fully believe that balance remains the best antidote to uncertainty, and my goodness, is there a lot of uncertainty to go around today.
Adam, I think one more thing we haven't talked about today but worth touching on is how quickly we have seen interest rates shift higher. Some of it inflation expectation, clearly, some of it perhaps just some recognition that the Treasury maybe isn't as safe as we thought it was previously. Still, obviously, a pretty low rate relative to history, but higher than it was. We have seen fixed income investors be challenged a bit alongside their stocks.
In a single word, oof. That's what it has felt like this past few weeks. As much as we talk about the ups and downs in the stock market, we've seen a lot of movement in a short period of time in the bond market. Yields have spiked quickly. From what was 3.9% a handful of trading days and weeks ago up to about 4.4, 4.5. I realize you might think, 3.9 and 4.5 is not that far away in the world of bonds. That is a lot to move in a very short period of time. And we're now back to the levels in the bond market last seen essentially in the aftermath of Liberation Day. The bond market is essentially mirroring the same concerns that stocks are seeing right now. And it's just a reminder to investors that you have to stay focused on quality. This is true for both bonds and for stocks.
And I would then put one final reminder that the purpose of fixed income is to collect your coupons. It's to get the interest payments. And I think sometimes we get caught up in bond prices moving even sometimes much faster than we're used to. Certainly we've seen that recently, that bond prices have come down. We walk everyone through some quick bond math. The 10-year Treasury right now, a little more than 0.25% higher than where it started the year. So you take a bond portfolio with a duration of, we'll call it 4 years to keep the math simple, down 0.25%, or rather up 0.25% on rates, you've now lost 1% on your bond prices in the span of 3 months. But a reminder that you are being paid to own those bonds along the way. You are collecting your coupon, you're collecting interest payments, and with the 10-year Treasury north of 4% right now, in the span of the first 3 months of the year, you're going to collect a little more than 1% on those bonds. And so, the price is down 1, your coupons give you that 1 right back, and all of a sudden you're flat. And so the reason that 2022 hurt as much as it hurt is not that bond prices went down. It's that there was no coupon to catch you up to what you were missing from the prices. We started from zero. And when you go from 0 to 3,000 as quick as we went, and it was a 1.25, 1.5 up to 5.25. When you go that quickly, there's not enough payment to catch up with what you're missing on the price side. This time around, and again, there's a danger in saying this time around is different, but this time around you are being paid to own those bonds, and it hasn't hurt quite as much to see that rate pop. Now, we see rates continue to go up at this pace. You're going to see a little more impact, and bonds are going to go from being around flat on the year to maybe down a little bit. It's not down the 8, 10, 12% that stocks are down right now, and certainly not down as bad as it can get when the stock market really gets dicey. So I think a good reminder, Adam, for balance, as you said, and a good reminder that there's more to our portfolio than simply what today's price is versus yesterday's. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.